Welcome to the July 31st, 2017 Advance Report for McGowanGroup Asset Management clients. Each week, we're going to bring to life what's actually happening in the markets with insights and, of course, graphics that you just can't get anywhere else. First slide, the real picture on interest rates. You heard about the Federal Reserve raising the target interest rate. Here they've gone from a quarter max to 1 1/4 max, and that is since the beginning of 2016. What happened to long-term rates? Surprise, the real picture is long-term interest rates actually dropped. You can see the T-bill moved lockstep with the Fed funds rate. Why? Bank arbitrage. If my bank is going to loan your bank money, well, the T-bill is one choice. The other is the federal funds dictated overnight lending rate. Now, here's the strange thing. The 30-year U.S. Treasury declining after 3 consecutive increases in the Fed funds rate. So this rate moved down. This rate, of course, dictated moved up, and T-bills followed lockstep. Now we look at the price of the high-yield, short-term high-yield corporate index, the B-rated index, often referred to as junk bonds in recessions because the default rate goes up. Here, we were anticipating lots of defaults, obviously. That index has risen to about 89 cents on the dollar. Are high-yield U.S. corporates overpriced? No, not relative to the Treasury we just looked at. It's a superior interest rate even after factoring in the current default rate, which has plummeted actually on the recent growth, which we're about to get to. So how much more can it go? Here, equilibrium was somewhere around 95, 96, and of course, we'll continue to monitor this for the portfolios. If we look at the S&P 500, the real story on earnings is here. The actual 12 months trailing profit of the S&P 500 and, of course, price. Notice that earnings actually justify the current rally, at least in direction. Are things overvalued? Well, let's put it in the context of the Federal Reserve forecast. But notice this incredible rally. This is a 5-year chart, and of course, the trailing 12-month earnings clearly in record territory. There's part of the explanation for this rally. And of course, you can see the correction back in early 2016, and of course, the post-election rally. What's intriguing, part of that rally wasn't political. Part of that rally is just pure profit and a little optimism from deregulation. Now we get to the Fed funds forecasts. Why is the Fed, could it be that the deep state is there in the Fed too? Looks like it to me, because if we take the change in GDP projected, they actually take the growth rate in the U.S. economy down. Are they ignoring deregulation? Are they ignoring potential tax cuts? That chart says so. Now we go to inflation. Well, this is about 2% as far as the eye can see, with a tendency of a slight increase between here and 2019. We're going to post this on the Busy Box at NetWorthRadio.com, and you can join us there for the extended version of this week's program. Thank you for tuning in, and be sure to send the link to your friends if you think it's worthy. I'm Spencer McGowan, NetWorthRadio.com, President, McGowanGroup Asset Management.